Before we begin, a quick and important disclaimer. I am not a licensed insurance agent or a financial advisor. This presentation is for educational and informational purposes only. The world of insurance is complex and state-specific. You should always consult with a qualified, licensed professional to discuss your individual business needs before making any policy decisions. A landscaper in Florida had a great business. 3 trucks, a solid crew, profitable. One of his drivers on his way to a job site glanced down at his phone for just a split second. In that instant, he drifted across the center line and clipped an oncoming sedan. It wasn't a high-speed crash, but the driver of the sedan was a concert pianist. The accident resulted in a wrist injury, a minor one, but enough to affect the dexterity required for her profession. 8 months later, a certified letter arrives. The pianist is suing for $3 million, claiming the accident caused permanent nerve damage that effectively ended her career. The business owner, let's call him Mark, thought, "This is terrible, but that's what insurance is for." He called his agent, confident he was covered. The agent's next words destroyed his entire life's work. "Mark, your policy limit is $1 million. The lawsuit went to court. The jury sided with the pianist. The final judgment was for $2.5 million. The insurance paid its $1 million, and Mark was personally on the hook for the remaining $1.5 million. His business was wiped out. The trucks were sold. His employees were let go. He lost his family home. Everything he had spent 20 years building was gone. Not because he was a bad businessman, but because of one single line item on an insurance policy he never truly understood. This story, or a version of it, happens every single day in America. Business owners, just like you, are driving around with financial time bombs under the hood of their company, and they don't even know it. You believe the commercial auto policy you pay for every month is a shield, when in reality it's often full of holes. You buy on price, not on protection, and you find out the devastating difference when it's far too late. That ends today. In this video, we are going to pull back the curtain on the commercial auto insurance industry. I'm going to give you the exact framework to analyze, understand, and build a policy that is an ironclad fortress around your business and your personal assets. You will learn the critical coverages you cannot live without, the expensive add-ons you can probably skip, and the key questions to ask an agent that will instantly tell you if they know what they're doing or if they're just trying to sell you the cheapest plan. By the time you're done watching, you will be more informed than 95% of business owners on the road, and you will have the confidence to secure the right protection for your company's future. And let me be crystal clear. The stakes have never been higher. We are living in the age of nuclear verdicts. That's the industry term for jury awards that exceed $10 million, and they are skyrocketing across the country. A simple delivery van accident that might have been a $50,000 claim 10 years ago can easily become a $5 million lawsuit today. Your business is a target. Every single time one of your vehicles pulls out of the driveway, you are exposed to a level of risk that can erase you overnight. That old $1 million liability policy that used to be the gold standard? For many businesses today, that's now dangerously, catastrophically inadequate. So where do we start? We start by dismantling the single most common, business-ending mistake I see: using your personal auto insurance for your business vehicle. If you are a sole proprietor, a freelancer, or a small business owner, and you are using your personal car or truck for work and relying on your personal auto policy, I need you to listen very carefully. You are likely driving with zero effective coverage. Buried deep in the fine print of almost every personal auto policy is something called the business use exclusion, or the commercial use exclusion. This clause essentially says that if you are in an accident while performing duties related to your work, the policy is void. The insurance company owes you nothing. Let me give you some real-world examples. Are you a real estate agent driving clients around in your personal SUV? You get into an accident. The claim is denied. Business use. Are you a pizza delivery driver using your own Honda Civic? You run a stop sign. Denied. Are you a handyman with your tools in the back of your personal pickup truck, driving from one job to another? You get rear-ended, and the crash pushes you into another car. Your insurance company could deny the entire claim for both your truck and the damage you cause, because you were in the course of business. They will argue that the primary use of the vehicle at that moment was commercial, not personal. It doesn't matter if you also used that truck to pick up groceries. At the moment of the accident, its purpose was commercial. And it gets worse. Let's say you have an employee. You send your assistant to the post office in their own car to mail some packages for the business. On the way, they cause a major accident, seriously injuring someone. Guess who gets sued? The injured party's lawyer will sue your employee, and they will absolutely sue your business under a legal doctrine called vicarious liability, which means the employer is responsible for the actions of its employee. Your personal auto policy won't cover it. Your employee's personal policy will likely deny it because of their own business use exclusion. Your business is now completely exposed with no insurance shield at all. This is not a rare loophole. It is a standard feature of personal insurance. It's designed to push business risk onto commercial policies, which are priced for that higher level of risk. So now that we've established you absolutely 100% need a dedicated commercial auto policy, let's talk about its number one job: protecting you from financial ruin. This isn't about fixing your truck's bumper. It's about paying for the other guy's medical bills, their lost wages, their lifelong pain and suffering, and the army of lawyers that comes with it. This is liability coverage. This is the core of your policy. It's the coverage that pays for the damage you cause to others. It's broken into two main parts: bodily injury, or BI, which covers injuries to people, and property damage, or PD, which covers damage to things like cars, buildings, or guardrails. When you buy liability coverage, you'll see the limits expressed in one of two ways: split limits or a combined single limit, also known as a CSL. Understanding the difference is critical. Split limits are what you typically see on personal auto policies. It looks like three numbers, for example 100/300/50. The first number is the maximum the policy will pay for bodily injury to a single person, $100,000. The second number is the maximum it will pay for bodily injury for the entire accident, no matter how many people are hurt, $300,000. The third number is the maximum it will pay for all property damage, $50,000. The problem with split limits is that they are rigid. If you cause an accident that seriously injures one person, leading to $200,000 in medical bills, your 100/300/50 policy will only pay the first $100,000. You are personally on the hook for the other $100,000, even though you technically had $300,000 of total injury coverage. This is why, for any business, you should almost always insist on a combined single limit, or CSL. A CSL policy gives you one big pot of money that can be used for bodily injury or property damage in any combination, up to the policy limit. If you have a $1 million CSL policy, you have a flexible $1 million shield. If you cause an accident that injures one person to the tune of $800,000 and causes $50,000 in property damage, the policy can cover the entire $850,000. There are no restrictive sublimits. A combined single limit provides far superior, more flexible protection in the real world of unpredictable accidents. If an agent is trying to sell you a split limit policy for your business, it should be a major red flag. Understanding your liability is the bedrock of a solid policy. It's the first and most important decision you will make. But that's only one piece of the puzzle. Protects you from the other guy, but what protects your assets? What protects that $70,000 F-250 you just bought? What happens if an uninsured driver plows into it while it's parked? Or if a hailstorm turns your brand new cargo van into a giant golf ball? That's where physical damage coverage comes in, and the choices you make here can save you, or cost you, tens of thousands of dollars when you finally need to file a claim. And that's exactly what we're going to break down next. Physical damage coverage is essentially a tale of two choices, two doors you can walk through. Behind door number one is collision coverage. Behind door number two is comprehensive coverage. And sometimes there's a tricky third door called specified perils. Picking the right door isn't just about ticking a box. It's about understanding the story of what could go wrong on your worst day. Let me tell you about a guy named Frank. Frank runs a successful HVAC business. He just bought a brand new gleaming white Ford Transit van. He was proud. He spent an extra $15,000 upfitting it with custom aluminum shelving, specialized ladder racks, and secure bins for all his expensive copper fittings and tools. This van wasn't just a vehicle. It was his mobile command center. It was his livelihood. When Frank called his insurance agent, he was focused on one thing: keeping the monthly premium low. He's a smart business owner, always watching the bottom line. The agent asked about physical damage. Frank said, "Yeah, of course I need it. If I crash this thing, I need it fixed." So he got collision coverage. The agent then asked about comprehensive. Frank hesitated. "What's that? Theft and stuff? I work in good neighborhoods. I locked my doors. Let's just skip it, save a few bucks." The agent advised against it, but Frank was firm. He was saving about $40 a month. A small victory. 6 months later, Frank was on a big residential installation job. He parked the van on the street in a quiet, upscale cul-de-sac. He and his apprentice worked all day, going back and forth to the van for parts. At 5 p.m. they packed up their hand tools, exhausted, and walked back to where the van was parked. Except it wasn't there. Panic set in. They searched the street. Frank thought maybe he'd forgotten where he parked. Then the cold, sinking feeling hit him. He called the police. His van, his $50,000 van, plus the $15,000 in custom shelving, plus another $20,000 in tools and equipment inside, was gone. Vanished. The next day, he made the call to his insurance company. Heart-pounding but still hopeful. He had insurance after all. He told them the van was stolen. And then the agent on the other end delivered the soul-crushing news. "Mr. Henderson, I'm so sorry to hear this. I'm looking at your policy. And I see you have collision coverage which would cover damage from an accident. But I'm afraid you declined comprehensive coverage." Frank's blood ran cold. "What does that mean?" "It means," the agent said gently, "that the theft of the vehicle is not a covered loss." In that moment, Frank didn't just lose a van. He lost $85,000. He lost his ability to work. He lost jobs he had lined up. That $40 a month he saved cost him his business. He had to lay off his apprentice and sell his home to cover the debts. Frank's story is a tragedy, and it happens every single day. All because of a misunderstanding of these fundamental coverages. Let's not let that be you. Let's break this down. Collision coverage is exactly what it sounds like. It pays to repair or replace your vehicle if it's damaged in a collision with another object. That could be another car, a guardrail, a telephone pole, or yes, a giant golf ball falling from the sky. It doesn't matter who is at fault. If you back into a pole, collision covers it. If someone runs a red light and T-bones you, collision covers your vehicle, while their liability coverage is sorted out. It's the coverage for the crunch. Comprehensive coverage, sometimes called other than collision, is the hero of Frank's story. This is the coverage for almost everything else. It's for the unpredictable, the acts of God and the acts of criminals. Theft is the big one. Vandalism. Someone keys your truck or spray paints your logo. Fire. A tree branch falling on your roof during a storm. Hitting a deer on a dark country road. Floods. Hail damage. Comprehensive is the safety net for the chaos of the world. For the vast majority of businesses, this is not optional. It is absolutely essential. Declining it to save a few bucks is like removing the fire extinguishers from your building to save on inspection fees. It's a gamble you can't afford to lose. Now what about that third door, specified perils? This is a budget version of comprehensive. Instead of covering everything except collision, it covers only a specific list or perils named in the policy. Typically, this list will include major events like fire, theft, and lightning. But it's what's not on the list that can get you. Vandalism might not be on the list. Hitting an animal might not be. A falling object might not be. You're saving a little bit of money, but you're opening yourself up to a dozen gaps in coverage. Unless you have a very specific reason and have reviewed the list of perils with a magnifying glass, you should almost always opt for the broader protection of comprehensive. Okay, so you've made the smart choice. You've got collision and comprehensive. You're covered, right? Not so fast. There's another critical detail hidden in the fine print that can make a $10,000 difference in your payout. How the insurance company values your vehicle. Most standard policies pay out on an actual cash value, or ACV basis. This is one of the most misunderstood terms in all of insurance. Actual cash value does not mean what you paid for the vehicle. It does not mean what it costs to buy a new one. It means what your vehicle was worth the microsecond before it was destroyed. It's the replacement cost minus depreciation. Think of it this way. Your 3-year-old truck might cost $70,000 to replace with a brand new one, but its ACV, after factoring in mileage, wear and tear, and market conditions, might only be $45,000. That $25,000 gap comes straight out of your pocket. This is especially brutal for businesses like Frank's. Remember that $15,000 in custom shelving and racks he installed? Under a standard ACV policy, that equipment is often depreciated heavily or, in some cases, barely valued at all. The insurer might say, "Sure, you paid $15,000, but that's used equipment now. We'll give you $4,000 for it." It's a financial gut punch when you're already down. So what's the alternative? It's called stated amount, or agreed value coverage. With this, you and the insurance company agree on the value of your vehicle upfront when you buy the policy. You say, "My truck is worth $50,000, and the permanently installed equipment is worth $15,000. I want to insure it for a stated amount of $65,000. They'll verify it's a reasonable value, and you'll pay a premium based on that number. Now, if the truck is totaled or stolen, the payout will be the lesser of the stated amount, the actual cash value, or the cost to repair. But having that stated amount as the ceiling provides a crucial layer of protection, especially for customized, classic, or high-value vehicles where standard depreciation tables don't tell the whole story. For Frank, a stated amount policy would have been a financial lifesaver. Finally, let's talk about the one number you have the most control over: your deductible. The deductible is simply the amount of money you have to pay out of pocket on a claim before the insurance company pays a dime. If you have a $1,000 deductible and a $5,000 repair bill, you pay the first $1,000, and the insurance company pays the remaining $4,000. It's a simple trade-off. A higher deductible means a lower monthly premium. A lower deductible means a higher monthly premium. Many business owners are tempted to jack up the deductible to $2,500 or even $5,000 to save money on the premium. And that can be a smart move, but only if you are disciplined. You have to ask yourself one brutally honest question. If my truck was wrecked tomorrow, do I have $5,000 in cash right now that I can use to get it back on the road without crippling my business? If the answer is no, then a high deductible isn't saving you money. It's a time bomb. A better strategy is to choose a deductible you know you can comfortably cover, say $1,000, and keep that amount tucked away in a separate business savings account. That way, you're prepared for the worst, and you're not scrambling for cash when disaster strikes. We've now rebuilt Frank's policy the right way. We've protected the van itself from crashes, theft, and acts of God. We've made sure it's valued correctly to account for all his custom upfitting. But we've only solved half of his problem. Because when Frank's van disappeared, so did $20,000 worth of tools, equipment, and inventory. All his Milwaukee power tools, his diagnostic cameras, his copper fittings, his entire ability to do his job. All gone. And here is the terrifying truth that almost no one tells you. A commercial auto policy pays for the vehicle. It does not pay for the stuff inside it. Covering that requires a completely different type of insurance, and not having it is a silent business killer that has wiped out countless contractors and tradespeople. And that's the critical piece of the puzzle we're going to solve next. That missing piece is called inland marine insurance, and the name itself is so confusing it's a big reason people don't have it. But before we get into the weird name, let me tell you about a guy named Dave. Dave was a master electrician. He'd been in the game for 15 years, built his business from the ground up, one job at a time. His work van wasn't just a vehicle, it was his mobile command center. Inside, he had over $30,000 worth of specialized equipment: conduit benders, thermal imaging cameras, high-end multimeters, wire tuggers, the tools of a true professional. Dave had commercial auto insurance. He was a responsible business owner. He called his agent, said he needed his van covered, and he paid his premium every month on time. One Tuesday morning, he walks out of his house, coffee in hand, ready to head to a big commercial job site, and his heart just drops into his stomach. The spot where his van was parked is empty, just a little oil stain on the asphalt. Panic sets in. He calls the police, files a report, and then with a bit of relief he calls his insurance agent. He thinks, "This is horrible, but this is why I have insurance. They'll cut me a check for the van, I'll get a new one, and I'll have to rebuy all my tools, but the insurance will cover it." The agent is sympathetic. They start the claim for the van, no problem. The van itself was valued at $40,000. Then Dave starts listing the tools. He has a detailed inventory, he's proud of it. As he's listing everything out, there's a long, uncomfortable pause on the other end of the line. The agent finally says, "Dave, I've got some bad news. The policy covers the van. It covers the custom shelving you had installed inside it, but it doesn't cover your tools." Dave's world just imploded. $30,000 of equipment gone. The insurance company paid for the $40,000 van, but the $30,000 in tools? That was a complete loss. He had to drain his savings, max out his credit cards, and borrow from family just to re-equip himself enough to get back to work. Set his business back years. He almost lost everything. Dave's story isn't unique. It happens every single day to contractors, plumbers, landscapers, and every other tradesperson who works out of a vehicle. They all make the same logical but incorrect assumption. that commercial auto insurance covers the truck and everything in it. It does not. Your commercial auto policy covers the vehicle itself, the chassis, the engine, the truck bed, and any equipment that is permanently attached to it. That ladder rack bolted to the roof? Covered. The toolbox welded to the truck bed? Covered. The $5,000 generator sitting in the truck bed? Or the $20,000 of tools sitting in the toolbox? Not covered. Not one penny. That's where inland marine insurance comes in. And yes, the name is terrible. Sounds like it's for boats on a lake. The name is a historical leftover from the 17th century, when insurance was all about covering ships and cargo crossing the ocean. That was marine insurance. As commerce moved inland via rivers and canals, they needed a new product to cover goods being transported on barges. They called it inland marine. Over time, as transportation shifted to railroads and then to trucks, the name just stuck. So today, inland marine is the industry term for insurance that covers property that is in transit or temporarily stored somewhere other than your main business location. It's insurance for property that moves. For a contractor, the specific type of inland marine policy you need is usually called a contractor's tools and equipment floater. Let's break that down. Contractor's tools and equipment is self-explanatory. The magic word is floater. A floater policy means the coverage isn't tied to a specific location like your shop or your house. The coverage floats with your tools. So whether your tools are in your truck on a job site overnight or in your garage, they're protected against theft, damage, or fire. This is the policy that would have saved Dave. It's designed specifically to fill that massive, business-destroying gap left by commercial auto insurance. Covers the portable stuff. Your power tools, your hand tools, your testing equipment, your generators, your compressors, everything you take with you to do your job. Now, there are two main ways to structure this coverage. The first is unscheduled coverage. This is a blanket limit for all your tools. You might say, I want $10,000 of blanket coverage for my tools. This is great for smaller hand tools and items that are hard to list individually. If you have a theft, you don't need to prove you owned every single screwdriver. You just need to prove you had about $10,000 worth of tools. The downside is there's usually a per item limit, maybe $500 or $1,000. So if your $5,000 thermal camera gets stolen, you'd only get the per item limit back. That's why you also need scheduled coverage. This is where you list out your big-ticket items individually. You schedule them on the policy. Your thermal camera, your ProPress tool, your heavy-duty demolition hammer. Anything worth more than the unscheduled per item limit gets its own line item on the policy, with its specific serial number and replacement value. This way, if that specific item is stolen, you get its full value, not some small capped amount. A good policy will have a mix of both. A blanket limit for the small stuff and scheduled coverage for the expensive gear. And the protection goes beyond just theft. Let's say you're driving to a job and you get into an accident. Your truck is damaged, but so is the brand new $10,000 HVAC unit you have in the back that you were about to install for a client. Your commercial auto policy will fix your truck. Your inland marine policy, specifically a type called an installation floater, is what pays to replace that HVAC unit. An installation floater covers materials and equipment from the moment they leave your shop until they are fully and finally installed, and the customer has accepted the job. It protects you during that vulnerable in-between phase of transit and installation. So how much does this critical business-saving coverage cost? You're probably thinking it must be incredibly expensive. It's not. For many small businesses, a robust tools and equipment policy might cost anywhere from $40 to $100 a month. Think about that. For the price of a couple of nice lunches, you can protect $30, $40, or $50,000 worth of essential equipment. When you compare that small, predictable monthly cost to the catastrophic, unpredictable loss that Dave experienced, it's not just a no-brainer. It's financially irresponsible not to have it. Here's your action plan. First, pull out your phone right now and start taking pictures and videos of every tool and piece of equipment you own. Open up the toolboxes, the truck bins, everything. Get serial numbers. Create a spreadsheet. It might take an hour, but this inventory is pure gold. If you ever have a claim, this list will be the difference between a quick, easy payout and a long, drawn-out fight with the insurance company. Second, call your insurance agent tomorrow. Do not email, do not wait. Call them and say these exact words. I need to add a contractor's tools and equipment floater to my policy. I want to discuss scheduled and unscheduled limits. Use their language. Shows you know what you're talking about. Walk them through your inventory list. Make sure the limits you choose are high enough to actually replace everything if you had a total loss tomorrow. Don't insure $20,000 worth of tools for a $10,000 limit just to save $10 a month. Be honest about what you have. By making that one phone call, you are building a firewall between a bad day, like your truck getting stolen, and the end of your business. You're closing one of the most common and dangerous loopholes in business insurance. You're ensuring that you can get back to work and keep earning a living no matter what happens. So now we've protected the vehicle itself with commercial auto, and we've protected the vital equipment inside it with inland marine. We've plugged the two biggest holes. But what happens when your vehicle doesn't just get stolen, but is actively involved in something far more common and potentially far more expensive? An accident. What happens when your truck hits something or someone? The cost to repair a bumper is nothing compared to the cost of a lawsuit. And a seemingly minor fender bender can spiral into a multi-million-dollar legal nightmare that can vaporize not just your business, but your personal assets as well. And that's the terrifying reality we're going to confront next. Let's paint a picture. Meet Sarah. She owns a thriving local flower shop called Pedal Pushers. It's her dream built from scratch. She has 2 employees and 1 delivery van. It's a small, honest business. One Tuesday afternoon, her driver, Mark, is on his way to a wedding delivery. He's stopped at a red light, glances down at the GPS for a split second, and when he looks up, the light is green and the car in front of him hasn't moved. He taps the brakes, but it's too late. It's a low-speed 5-mile-per-hour tap. A classic fender bender. The other car is a late-model Mercedes. The driver, a well-dressed man in his 50s, gets out. He's angry, but he's walking and talking just fine. There's a small crack in his bumper. They exchange insurance information. Mark apologizes profusely. The man says, "My neck is a little stiff, but I'm probably fine." They both drive away. Mark calls Sarah, explains what happened, and she files a claim with her commercial auto insurance. She's annoyed, but she thinks, okay, we'll pay the deductible, our rates will go up, and we'll fix his bumper. Annoying but manageable. That is not what happened. 3 weeks later, a thick envelope arrives by certified mail. It's not from the other driver's insurance company. It's from a law firm. One of those personal injury firms with their face on billboards. The letter informs Sarah that their client, the man from the Mercedes, has suffered severe and debilitating soft tissue injuries to his neck and back, requiring extensive medical treatment, physical therapy, and resulting in chronic pain and a significant loss of enjoyment of life. He's a high-income consultant, and the letter claims he's been unable to work. The demand to settle out of court is for $1.5 million. Sarah's heart stops. She pulls out her insurance policy. She had worked with an agent who told her she had a great policy that met all the state requirements. She looks at her liability coverage. It reads, $100,000 per person, $300,000 per accident for bodily injury, $100,000 for property damage. She has what's called a split limit policy. She thought those numbers sounded huge when she bought the policy. Now, looking at a $1.5 million demand, they feel like pocket change. This is the first, most fundamental part of your commercial auto policy you need to understand. Your liability limits. This is the absolute maximum amount your insurance company will pay out for damages you cause. Bodily injury liability covers medical bills, lost wages, and pain and suffering for people you injure. Property damage liability covers the cost of repairing or replacing the vehicle or property you damage. Many small business owners make Sarah's mistake. They get the state minimum requirement or just a little bit more thinking they're covered. But state minimums are designed to provide a tiny safety net for the other person, not to protect your business. They are dangerously, catastrophically low. A single serious accident can easily exceed those limits. We're not even talking about a multi-car pileup. One person, one injury, one surgery, and you can blow past a $100,000 limit before the first hospital bill is even paid in full. And once that limit is reached, the insurance company writes the check and their obligation ends. But the lawsuit doesn't. The lawyers for the injured party will then come after everything else. Your business bank accounts, your equipment, your delivery vans. And depending on how your business is structured, if you're a sole proprietor or a partnership, they can come after your personal assets, your house, your savings, your kids' college fund, everything. A much safer option for most businesses is a combined single limit, or CSL. Instead of splitting the limits for bodily injury and property damage, A CSL policy provides a single, large pool of money that can be used for any combination of damages in an accident. A $1 million CSL is standard. It means you have $1 million available, whether you damage a $10,000 car and injure one person, or cause a multi-car pileup with multiple injuries. It's a bigger, stronger financial shield between a lawsuit and your life's work. Back to Sarah. She calls her insurance company, her voice trembling. The good news? Her policy includes a duty to defend. This is a critically important clause. It means that the insurance company is obligated to hire and pay for lawyers to defend her and her business against the lawsuit, even if the claims are exaggerated or completely fraudulent. This is a massive benefit. Legal defense costs can run into the tens, even hundreds of thousands of dollars very quickly. But here's a terrifyingly subtle detail you must look for in your policy. Are the defense costs inside or outside the liability limits? If they are outside the limits, the insurance company pays for your legal defense, and you still have your full liability limit. In Sarah's case, $100,000 to pay for a settlement or judgment. But if your policy states that defense costs are inside the limits, every dollar the insurance company spends on lawyers erodes your total coverage. If they spend $75,000 on lawyers defending the case, you now only have $25,000 left to actually pay the claim. It's a policy that eats itself alive just when you need it most. Sarah's legal battle begins. The plaintiff's lawyers start the discovery process. They demand years of her business's financial records, maintenance logs for the van, her driver Mark's employment history, his driving record, even his cell phone records to see if he was texting. Mark has to sit for a deposition, a grueling 8-hour session of questions designed to trip him up. Then it's Sarah's turn. They grill her about her hiring practices, her safety protocols, her revenue. They are not just building a case about a fender bender. They are assessing the total value of her business and personal assets to see how much they can take. Her dream of owning a flower shop has turned into a full-time nightmare of legal paperwork and crippling anxiety. Now let's flip the script for a moment to highlight another crucial coverage. What if it wasn't Mark's fault? What if Mark was sitting at that same red light, and he was the one who got rear-ended by a driver who had no insurance or the absolute state minimum? And what if Mark was seriously injured? Now Mark can't work. He has medical bills piling up. He might sue the other driver, but that driver has no money and no insurance. He's a ghost. So who pays for Mark's injuries? You might think, well, that's what workers' compensation is for. And you'd be partially right. Workers' comp would cover his medical bills and a portion of his lost wages. But it doesn't cover pain and suffering. It doesn't cover the full financial devastation an injury can cause. And so, Mark, your loyal employee, might be forced to sue you, his employer, to be made whole. This is where uninsured and underinsured motorist coverage, or UM/UIM, becomes your savior. This coverage steps in and acts like the at-fault driver's insurance when they have none. It pays for your medical bills, your employee's medical bills, and your lost wages if you're hit by an uninsured or underinsured driver. It protects your most valuable asset, your people. Skimping on UM/UIM to save a few dollars is betting that every other driver on the road is as responsible as you are. And in today's world, that is a losing bet. For Sarah, her nightmare is far from over. The lawsuit is a dark cloud that follows her everywhere. The legal fight is draining her savings and her spirit. She's learned the hard way about the true meaning of liability limits and the duty to defend. But as she's fighting this battle over a past event, a new, more immediate crisis is unfolding. Her delivery van, the one from the accident, has been sitting in a tow yard, tangled in red tape. It's evidence. It can't be repaired yet. And without that van, she can't make her deliveries. The daily revenue of her business, the very lifeblood she's fighting to protect in court, is slowing to a trickle. The lawsuit threatens to take what she's built, but the loss of her vehicle is stopping her from building anything new. And that's the second front in this war, where the physical damage to your vehicle triggers a financial collapse in your operations. This second front is often more insidious, more immediately crippling than any lawsuit. A lawsuit is a threat on the horizon. A disabled truck is a crisis on your doorstep. For Maria, the caterer, her specialized van wasn't just a vehicle. It was her kitchen, her office, her entire means of production. And right now, it's a twisted wreck in an impound lot. The engine is ruined, the custom shelving is destroyed. The side panel with her beautiful logo looks like a crushed soda can. So, how does she fight this battle? How does she get her business moving again? This is where we talk about the armor for your actual assets. Physical damage coverage. It's not one single thing. It's typically a combination of two core coverages, and the first one is designed for exactly what happened to Maria. It's called collision coverage. The name is simple and so is the concept. If your commercial vehicle collides with another object, be it another car, a telephone pole, a guardrail, or even if it flips over, collision coverage pays to repair or replace it. It's the knight in shining armor that shows up to fix your chariot after the joust. But this knight doesn't work for free. Before he lifts a hammer, you have to pay your deductible. Let's imagine when Maria first bought her policy. Her agent asked her to choose a deductible. Maybe she had the choice between $500, $1,000, or $2,500. Looking at her monthly premium, she saw that a higher deductible meant a lower monthly payment. Trying to manage her cash flow, she chose the $2,500 deductible. Saved her maybe $50 a month. At the time, it felt like a smart business decision. But now, standing in the wreckage of her business, that decision feels very different. The insurance adjuster has declared the van a total loss. They've determined its value right before the crash was $35,000. To get that check, Maria first has to write one of her own for $2,500. That's cash she desperately needs for other things right now. It's a painful lesson. A deductible isn't just a number on a page. It's the amount of cash you are contractually obligated to produce from your own pocket before your insurance kicks in a single dollar. For many small businesses, an unexpectedly high deductible can be the difference between a quick recovery and a slow, painful bankruptcy. So that's collision. Covers the damage from, well, a collision. But what about all the other bad things that can happen to a vehicle? What if Maria's van hadn't been in an accident at all? What if one morning she walked outside to find her parking spot empty because her van, full of expensive catering equipment, had been stolen overnight? What if a freak hailstorm pummels her van, leaving it looking like a golf ball? Or a disgruntled ex-employee decides to key the logo and slash the tires? Or in a classic but terrifying scenario, a deer jumps out on a dark road? These events are not collisions. If Maria only had collision coverage, she would be completely on her own. The cost to replace a stolen van or repair thousands of dollars in hail damage would fall entirely on her. This is where the second piece of the armor comes in: comprehensive coverage. Think of comprehensive as the shield against the unexpected, the non-collision chaos of the world. It's sometimes called other than collision coverage, which is a perfect description. It covers a whole list of perils: theft, vandalism, fire, hitting an animal, falling objects like a tree branch in a windstorm, floods, earthquakes, civil unrest. It's the coverage for the acts of God and the malicious acts of people. And just like collision, it also comes with a deductible that you have to choose and be prepared to pay. For a business owner, skipping comprehensive coverage can feel like a way to save money, especially if your vehicle is older. But you have to ask yourself a critical question. If my truck was stolen tonight, would I have the cash on hand to immediately buy a replacement tomorrow and keep my business running? If the answer is no, then comprehensive isn't a luxury. It's a fundamental necessity. Now, here's where things get really important. This is a detail that trips up so many business owners and leads to incredible frustration during a claim. Whether you're using collision or comprehensive, the insurance company has to decide how much your vehicle was worth. Maria's van was valued at $35,000. But how did they get that number? The default method for almost all standard auto policies is called actual cash value, or ACV. Actual cash value does not mean what you paid for the vehicle. It does not mean what it would cost to buy a brand new one. It means what your vehicle was worth the second before the loss occurred. It is the replacement cost minus depreciation. Depreciation is the enemy. It's the invisible force that's constantly reducing the value of your assets. The moment you drive a new vehicle off the lot, it depreciates. Every mile you drive, every little scratch, every year that passes, depreciation takes its toll. So when you have a claim, the insurance company will look at the make, model, year, mileage, condition, and recent sales of similar vehicles in your area, and they will come up with a number. That number is the ACV. And very often, that number is a lot lower than what the business owner feels their vehicle is worth. This is especially dangerous for vehicles like Maria's catering van. She spent $10,000 upfitting it with custom stainless steel counters, a commercial-grade refrigerator, and specialized shelving. To her, the van is worth the $50,000 she has invested in it. But an insurance adjuster using a standard ACV calculation might only give her a few thousand for that equipment, arguing that used, permanently installed equipment depreciates very quickly. So she gets a check for $35,000, but it's going to cost her $50,000 to replicate the van she needs to actually run her business. She's left with a $15,000 gap that she has to fund out of her own pocket. This is a business-killing scenario. So how do you prevent it? You do it by discussing better valuation methods with your insurance agent before you ever have a claim. There are two key terms you need to know: stated amount and agreed value. A stated amount policy lets you state the value of your vehicle. You tell the insurance company, "My truck with all its equipment is worth $70,000. They will then use that amount to help calculate your premium. But here's the catch, and it's a big one. In the event of a total loss, the insurance company will pay the stated amount or the actual cash value, whichever is less. So if you state $70,000 but they calculate the ACV at $55,000, you're only getting $55,000. It's better than nothing, but it's not a guarantee. The true gold standard, especially for customized or high-value vehicles, is agreed value. An agreed value policy is exactly what it sounds like. You and the insurance company agree on the value of the vehicle up front. When you buy the policy, you might have to provide receipts, appraisals, and photos to justify the value. But once that value is agreed upon, let's say $70,000 for your custom truck, it's locked in. If that truck is totaled a year later, there is no discussion about depreciation or ACV. You get a check for $70,000, minus your deductible. Period. It's the most predictable and secure way to insure a critical high-value asset. Costs more, absolutely, but it eliminates the nasty surprise of depreciation and ensures you have the exact funds you need to get back to work. So Maria's battle on this second front isn't just about having coverage. It's about having the right kind of coverage with the right valuation method. She thought she was protected, but the gap between her van's actual cash value and its true replacement cost is now a chasm she has to cross. Let's assume she navigates this. She pays her deductible, she argues with the adjuster, she scrapes together the extra money, and she finally gets a new van ordered and the custom upfitting scheduled. It's going to take 4 weeks. 4 weeks where she is unable to work any of the lucrative catering gigs she had booked. 4 weeks with zero income, while her business expenses, her insurance, her phone bill, her commercial kitchen lease, keep piling up. The physical damage is being handled, but the financial bleeding has just begun. This is the silent killer of so many small businesses. Not the crash itself, but the aftershock. The slow, grinding halt of cash flow while the fixed costs keep marching on, month after month. For Sarah, this wasn't just an inconvenience. It was a potential company-ending event. All her hard work, the late nights, the early mornings, the passion poured into every recipe. All of it was now teetering on the edge of a cliff. All because her one essential piece of equipment was sitting in a body shop. So what could she have done differently? What was the missing piece in her financial armor? It's a coverage so often overlooked, so frequently dismissed as an unnecessary expense, that many business owners don't even know it exists. It's not about fixing the vehicle. It's about replacing its function. We're talking about rental reimbursement and its more powerful cousin, loss of use coverage. Let's break this down, because understanding this distinction could literally be the difference between your business surviving an accident or becoming a statistic. The most basic version is rental reimbursement. It's exactly what it sounds like. Your commercial vehicle is damaged in a covered accident, and while it's being repaired, your insurance policy pays for you to rent a temporary replacement. It usually comes with a per-day limit and a maximum total limit. For example, your policy might offer $50 a day, with a maximum of $1,500 per claim. For a consultant who just needs a sedan to get to client meetings, this might be perfectly adequate. But for Sarah, $50 a day won't even cover the taxes on a rental refrigerated van. Her business doesn't just need 4 wheels and an engine. It needs a specialized tool. This is where the first critical takeaway comes in. You must match your rental reimbursement limits to the real-world cost of renting a comparable vehicle for your business. Before you ever sign a policy, call a commercial rental company. Get a quote for a 1-week rental of a vehicle just like yours. A cargo van, a box truck, a flatbed, whatever you use. That number is your reality check. If renting a replacement for your plumbing van costs $150 a day, and your policy only covers $50, you're still paying $100 out of pocket every single day just to stay in business. You're losing money just to keep from losing more money. Now let's step it up a notch to loss of use coverage. This can sometimes be more flexible. Instead of just paying for a rental, it might compensate you for other transportation costs, like using ride-sharing services or even paying for taxis to make deliveries. In some cases, it can provide a cash payment for the loss of income resulting from not having your vehicle. This is less common and the specifics are buried deep in the policy language, which is why you have to ask about it directly. Imagine if Sarah had a robust rental reimbursement policy. The day after the accident, instead of frantically calling clients to cancel, she would have been on the phone with a commercial rental agency. She could have had a replacement van, maybe not identical but functional enough, within 24 to 48 hours. Yes, there would have been a disruption. Yes, it would have been a massive headache. But she wouldn't have lost 4 weeks of income. She would have been able to service those lucrative catering gigs. Her revenue stream would have continued, bruised but not broken. The cost of that additional coverage, maybe a few $100s a year, is microscopic compared to the thousands of dollars in revenue she lost. But there's another level to this. A layer of protection that is the ultimate safety net for a business dependent on its vehicles. This is where we move beyond just replacing the vehicle and start talking about replacing the income. This is called business interruption insurance, sometimes known as business income coverage. Now, typically, this is part of a broader business owner's policy, or BOP, that covers your physical place of business. If a fire burns down your restaurant, business interruption insurance pays for your lost profits and ongoing fixed costs, like rent and salaries, while you rebuild. Most business owners think this only applies to their brick-and-mortar location. They are dangerously wrong. For many businesses, their vehicle is their place of business. A food truck isn't just a truck, it's a mobile restaurant. A contractor's van isn't just for transport, it's a mobile workshop. You can often add an endorsement to your commercial auto policy, or ensure your BOP is written correctly, to specifically cover the business income you lose when a vehicle is out of commission due to a covered peril. Let's rewind Sarah's story one more time, but this time, let's give her a policy with strong rental reimbursement and a business interruption endorsement. The accident happens. The next day, her rental reimbursement kicks in and she secures a temporary van. Maybe the rental van isn't as efficient. Maybe it takes her longer to load and unload, so she can only handle 1 catering gig a day instead of 2. She's operating but at a reduced capacity. Her revenue is down 50%. This is where the business interruption coverage performs its magic. It would look at her financial records, her projected income from the job she had booked, and it would pay her for that 50% of lost profit. But it gets better. It would also cover her ongoing expenses that continue even when her income is down. That commercial kitchen lease payment? Covered. Her business phone bill? Covered. The salary she pays her one part-time employee? Covered. Instead of bleeding cash and staring into a financial abyss, Sarah's business is kept on life support by her insurance. The accident becomes a manageable operational challenge, not an existential threat. The stress is still there, but the panic is gone. She has the breathing room to get her van repaired properly without cutting corners, and the peace of mind to focus on retaining her clients, knowing her bills are being paid. This is the profound difference between having insurance and having the right insurance. It's the difference between simply checking a box to be legally compliant and strategically building a shield to protect the business you've poured your life into. So, when you're looking at a commercial auto insurance quote, don't just glance at the liability limits and the premium. You need to become a detective. Look for the line items for rental reimbursement, loss of use, or non-owned vehicle coverage. Ask the hard questions. What are the daily limits? What is the maximum payout? Is there a waiting period before the coverage starts? Does this policy cover the actual cost to rent a vehicle like mine? Or is it a generic one-size-fits-none amount? And then ask the million-dollar question. How can I ensure the income this vehicle generates? Ask about business interruption endorsements. If your agent gives you a blank stare, you might be talking to the wrong agent. A true commercial insurance specialist will understand that for you. The vehicle isn't just an asset, it's the engine of your revenue. Sarah's story is a painful one, but it's a powerful lesson. The damage to her van was a visible, tangible problem that was easy to understand. But the real damage was invisible. It was the lost opportunities, the canceled contracts, the draining bank account. That's the wound that a basic policy doesn't cover. We've now fortified Sarah's business against the financial fallout of downtime. We've replaced her van and we've replaced her income. She's back on the road, her business is stable. But there's one more piece of this puzzle we haven't touched yet. When her van was hit, it wasn't empty. It was loaded up for a wedding reception. Inside were thousands of dollars worth of specialized equipment, custom-built hot boxes, expensive chafing dishes, high-end coolers, and an entire set of professional-grade serving utensils. All of it was thrown around violently in the crash. Some of it was dented, some of it was shattered. Is that covered? Does her commercial auto policy pay to replace the vital equipment inside the vehicle? The answer to that question might shock you. The answer for Sarah was a devastating, soul-crushing no. Her standard commercial auto policy, the one she thought was comprehensive, the one that covered liability and the physical damage to her van, did absolutely nothing for the contents inside it. To the insurance company, her $5,000 industrial steam cleaner, her specialized vacuums, and her high-end detailing supplies were just cargo. They were personal property being transported in the vehicle, not part of the vehicle itself. And her policy had a specific exclusion for it. Imagine that phone call. Sarah is standing on the side of the road watching her business, her entire livelihood, being hooked up to a tow truck. She's shaken, bruised, but she's thinking, okay, this is what insurance is for. It'll be tough, but we'll get through it. She calls her agent, explains what happened, and then asks the critical question. So, how do I start a claim for all my equipment? And there's a pause on the other end of the line. A pause that feels like an eternity. And then the agent says the words no business owner ever wants to hear. I'm sorry, but that's not covered under this policy. In that moment, Sarah's problem didn't just double. It grew exponentially. It wasn't just about getting her van repaired. It was about the fact that even if she had a brand new van delivered to her tomorrow, she would have nothing to put in it. She couldn't clean a single carpet. She couldn't detail a single car. Her business wasn't just damaged, it was vaporized. All because of a single, widely misunderstood gap in coverage. This gap has a name, and it's one of the most important and most confusing terms in the entire insurance industry. Inland marine insurance. Now, when you hear the word marine, you immediately think of boats, oceans, and shipping containers. And you're not wrong. That's where the term originated centuries ago. Marine insurance covered ships and their cargo on the high seas. But as commerce moved inland via railroads and eventually trucks, a new type of policy was needed to cover goods while they were in transit over land. So they called it inland marine. It's a terrible, outdated name, but it has stuck. For our purposes, I want you to completely forget the word marine and just think of this as stuff in transit insurance or mobile property insurance. This is a separate policy or a specific add-on, an endorsement, that protects your business property once it leaves your primary business location. Your standard commercial auto policy covers your truck. Your standard business property policy covers your office or your warehouse. But what covers the expensive tools, equipment, and merchandise in the space between those 2 points? That's the job of inland marine coverage. It's the missing link that connects all your other policies, and for businesses like Sarah's, it's not optional. It's the difference between a bad day and bankruptcy. Let's break down the most common types of this stuff in transit insurance, because it's not a one-size-fits-all product. First, and most relevant to Sarah, is contractors' tools and equipment coverage. This is designed for any business that moves its own tools and equipment to various job sites. Think of plumbers, electricians, landscapers, photographers, mobile mechanics, and of course mobile cleaners. This coverage protects your equipment, the stuff you own, from risks like theft from a vehicle, damage during a vehicle accident, fire, or vandalism. It doesn't matter if the tools are in your truck, on a job site, or temporarily stored somewhere else. They are covered. For Sarah, a policy like this, which might have cost her an extra $30 or $40 a month, would have provided the $10,000 she needed to replace every single piece of her broken equipment. Think about that. The cost of a few premium coffees a month versus the complete collapse of her business. Second, there's a crucial one for anyone in the transportation business: motor truck cargo coverage. This is different. This doesn't cover your property. It covers the property of others that you are being paid to transport. If you're a trucker hauling a load of electronics for a big box store, a courier delivering legal documents, or a local delivery service moving furniture for a client, this is your lifeline. You are the bailee, legally responsible for the safe transport of that cargo. If you get into an accident and that cargo is destroyed, the owner of those goods isn't just going to say, "Oh, that's a shame." They are going to come to you and your insurance company for the full value of what was lost. Without motor truck cargo coverage, a single accident could result in a lawsuit that shutters your entire operation. It protects you from liability for someone else's property that is in your care, custody, and control. Third, there's a more specialized but vital coverage called an installation floater. This is for contractors who not only transport materials but also install them. Imagine you're an HVAC company. You've just picked up a $20,000 commercial air conditioning unit. You transport it to the job site, and you're in the process of lifting it onto the roof with a crane when a cable snaps and the unit smashes to the ground. Who pays for that? The installation floater does. It covers your property from the moment it leaves your shop until the very second it is fully installed and the job is accepted by the client. It bridges the gap between transit and final installation, a period filled with unique risks. So, when we talk about finding the best commercial auto insurance, we have to expand our definition. The best policy isn't just the one with the right liability limits for the truck itself. The best insurance solution is a package that understands what your business actually does. It protects the vehicle, it protects you from lawsuits, and it critically protects the valuable property that makes your business run. An insurance agent who just asks for the year, make, and model of your van is committing malpractice, in my opinion. A great agent, a true risk advisor, will ask, okay, what's in the van? What are you hauling? What's its value? Where does it go? How is it used? They'll identify the need for tools and equipment coverage or motor truck cargo insurance because they understand that your vehicle is just a metal box. The value, the thing that generates income, is what's inside it. Sarah learned this lesson in the most brutal way possible. She's now facing two separate, monumental financial hits. The collision coverage on her commercial auto policy will eventually pay to repair or replace her van, but that comes with a deductible and the process takes time. But the $10,000 in equipment? That's a complete loss. It's a hole she has to dig herself out of. She has to drain her savings, max out her credit cards, or take out a high-interest loan just to get back to square one. All while her income is zero because she can't work. The accident was a setback. The lack of inland marine coverage was a potential knockout blow. Her mind is racing. This isn't fair. None of this was her fault. The other driver blew through a bright red light. He was clearly 100% at fault. So why is she the one on the hook for all of this? Shouldn't his insurance be paying for everything? For her van, her equipment, her lost income, everything? Seems so simple, so logical. But when you're dealing with insurance companies, what seems logical and what actually happens are often two very different things. Getting the other guy's insurance to pay up is a fight, and it's a fight that's about to get a whole lot more complicated than Sarah could ever imagine. The first call Sarah makes is to the number on the insurance card the other driver gave her. She's still a little shaky, but she's confident. The police report is clear. The other driver ran a red light. It's an open and shut case. A friendly voice answers the phone, takes the claim number, and connects her to an adjuster named Mark. And Mark is incredibly nice. He's sympathetic. He asks if she's okay, if anyone was hurt. He sounds genuinely concerned. This is going to be easy, Sarah thinks. Mark reassures her. Don't you worry, Sarah, we're here to take care of everything. We just need to get your side of the story to process the claim. And right there, the game begins. So, Sarah, Mark says, his tone still friendly, just to be thorough, can you walk me through what happened? Take your time. Sarah recounts the story. The green light, entering the intersection, the sudden impact. Mark listens patiently. Then come the questions. They start simple. What was the weather like? How was traffic? But they slowly, subtly begin to shift. Were you listening to the radio or on a hands-free call at the time? Sarah says no. Okay, and you were on your way to a client, right? Running a little behind schedule, maybe? The question is casual, but it's loaded. Sarah hesitates. No, I was on time. Mark just says, okay, great. But he's planting seeds. He's searching for a crack. He's looking for anything he can use to establish a sliver of shared responsibility. This is a strategy called comparative negligence. In many states, if an insurance company can prove you were even 1% at fault for an accident, they can reduce your payout by that same percentage. If they can prove you were 10% at fault, maybe you were going 1 mile per hour over the speed limit, or you didn't brake quite as fast as you could have, they can slash your claim by 10%. In a few states with a doctrine called contributory negligence, if they can prove you were even a tiny bit at fault, they can deny your claim entirely. Mark isn't just being thorough. He's hunting for a discount. He's a professional, trained to save his company money, and Sarah is an amateur walking onto his home field. Then comes the big one. Sarah, this all sounds really clear. Mark says smoothly. To make this process go as fast as possible for you, I'd like to get a quick recorded statement. It's just a formality. We'll go over the same questions, and it will really help us expedite payment for your van. This is the moment where thousands of accident victims make a catastrophic mistake. A recorded statement is not a formality. It is not for your benefit. It is a tool for the insurance company. Every word you say will be scrutinized, analyzed, and potentially used against you. Your your hesitations, your slight uncertainties. I think the light was green instead of the light was green, can be twisted to imply doubt. They can compare it to the police report, to your other statements, looking for the tiniest inconsistency to exploit. The correct answer, the only answer you should ever give to another driver's insurance company when they ask for a recorded statement is this: I'm not comfortable providing a recorded statement at this time. All communication should go through my insurance company. Sarah, however, doesn't know this. She wants to be helpful. She wants this to be over. She agrees. She gives the statement. And with that, she hands the other side a weapon to use against her. Days go by. Sarah calls Mark for an update. His tone is a little less warm this time. We're still investigating, Sarah. We haven't been able to get a statement from our insured yet. A few more days pass. Another call. Our investigation is ongoing. There seems to be a conflict between your statement and the initial information we have. What conflict? He won't say. He's vague. He's evasive. This is the delay tactic. Insurance companies know that you need your vehicle. They know your business is suffering. The longer they drag their feet, the more desperate you become. The more desperate you are, the more likely you are to accept a lowball settlement offer just to make the pain stop. And Sarah's pain is just beginning. Her van isn't just a van. It's her office, her warehouse, her billboard. It's the engine of her entire business. Every day it sits in the tow yard, she's losing money. She has to cancel jobs, reschedule clients, and refund deposits. Her reputation, which she has spent years building, is taking a hit. She's losing thousands of dollars. She needs a rental. But this is another trap. She calls Mark. What about a rental van? Mark tells her, well, we can't authorize a rental until we fully accept liability, and our investigation isn't complete. He's got her in a corner. She can't work without a van, but his company won't pay for one until they're forced to. This is where a critical piece of your own policy comes into play: rental reimbursement and hired auto coverage. Most standard commercial auto policies do not automatically include rental reimbursement. It's an add-on, and even if you have it, you have to look at the limits. A policy that pays $30 a day for a rental car is useless when you need a $150 a day cargo van. You need coverage that specifically provides for a temporary vehicle of a similar type and size to the one you use for your business. Even better is something called hired auto coverage. This is part of the broader hired and non-owned auto endorsement we mentioned earlier. Hired auto coverage protects you when you or your employees are driving a vehicle you've rented or borrowed for business purposes. In Sarah's case, if she had this coverage, she could have gone out, rented a van herself to keep her business running, and her own policy would have provided liability coverage for that rental. This decouples her ability to work from the other insurance company's delay tactics. It gives her power. It gives her options. Without it, Sarah's stuck. A week turns into 2. The tow yard is charging daily storage fees, which are adding up fast. The repair shop can't even give her a final estimate until the insurance company sends an appraiser. And they haven't done that yet because they haven't accepted liability. She feels completely powerless, tangled in a web of corporate red tape designed to wear her down. Finally, she gets a call from Mark. It's not the call she was hoping for. Sarah, he says, his voice now cold and official. Based on our investigation and a supplemental statement from our driver, we're finding shared fault in this matter. Our driver now states that you appear to be accelerating to try and make the light. It's a complete lie, a fabrication, but it doesn't matter. It's her word against their drivers. And because she gave that recorded statement, they've probably found a slight hesitation, a single phrase they can twist to support this new narrative. Mark continues, given the conflicting information, the best we can offer is a 50-50 settlement. We'll pay for half of your damages. Half of the $10,000 repair bill. Half of the towing fees. Nothing for the rental she needs. Nothing for the thousands of dollars in lost business income. It's a slap in the face. It's an offer designed to make her feel so defeated that she'll take anything just to end the nightmare. This is the reality of dealing with a third-party claim. You are not their customer. Their legal and fiduciary duty is to their own shareholder, not to you. Their goal is to pay out as little as humanly possible. Sarah, feeling utterly broken, finally realizes she has made a terrible mistake. She shouldn't have been fighting this alone. She picks up the phone, but this time she doesn't call Mark. She calls the one person she should have called on day one, her own insurance agent. The conversation she's about to have will change everything, revealing the true power hidden within the pages of a well-written commercial auto policy. Her heart is pounding as the phone rings. It's a number she has saved in her phone, but has never had to use for anything more than a routine policy question. A calm, professional voice answers on the second ring. Good morning. This is David at Premier Business Insurance. How can I help you? Sarah takes a deep breath, the frustration and fear of the last 2 weeks bubbling up. David, it's Sarah from Flower Power Bakery. I was in an accident. One of my delivery trucks. She spills the entire story. The intersection, the red light, the speeding driver, Mark. She tells him about the denials from Mark's adjuster, the ridiculous lowball offer of $3,000 for what is clearly $10,000 in damage. She explains the endless phone tag, the condescending tone, and the crushing weight of losing over $1,000 a day with her main truck out of commission. She feels like she's at the end of her rope, a small business owner being bullied by a corporate giant. When she finally stops, there's a moment of silence on the line. But it's not an empty silence. It's the sound of someone listening, processing. Sarah, David says, his voice still perfectly calm, which is somehow incredibly reassuring. First, I am so sorry you are going through this. This is exactly the kind of nightmare scenario we work to protect our clients from. Do you have your policy number handy? She reads it off the card she's been staring at for days. She hears the clicking of a keyboard. Okay, I have your policy right here in front of me, David says. Let's walk through this. First things first, I want you to stop talking to Mark's insurance company. Effective immediately. You are not to call them, and if they call you, you will politely tell them to direct all future correspondence to your agent, David, at this number. Understood. Sarah's taken aback. I can do that? You're not just allowed to do that, Sarah. That's what you pay me for. I am your advocate. Let me be the bad guy. Let me deal with their adjusters and their tactics. Your only job from this point forward is to focus on your bakery. A wave of relief washes over her, so potent it almost makes her dizzy. For the first time in 2 weeks, she feels like she isn't alone. Okay, David continues. Now let's talk about your truck. The $10,000 in damage. You've been waiting for them to pay you, right? Yes, Sarah says. And they're just dragging their feet, offering me pennies. We're not going to wait for them, David states plainly. Sarah, you have collision coverage on your policy with a $1,000 deductible. This is the single most important coverage for this exact situation. Collision coverage pays to repair your vehicle, regardless of who is at fault. It doesn't matter what Mark's insurance company thinks or says. We are going to fix your truck. Sarah feels a knot in her stomach loosen. But what about my deductible? I still have to pay $1,000. For now, yes, David explains. But here's the beautiful part. Once we pay for your repairs, our company then turns around and goes after Mark's insurance company. This process is called subrogation. We will fight them to recover every single dollar we paid out, and most importantly, we will fight to recover your $1,000 deductible for you. Since you have a police report that clearly states the other driver was at fault, the likelihood of us getting that money back for you is extremely high. So, you can stop wasting your energy fighting them. We're going to do it for you with our team of lawyers if necessary. Subrogation. She'd never even heard the word before. Sounded like a superpower. She didn't have to fight. Her insurance company would fight for her. Wow, is all she can manage to say. There's more, David says, his tone shifting slightly, like a magician about to reveal his best trick. You said you're losing over $1,000 a day because the truck is out of commission. That's the real killer here, isn't it? The repair bill is one thing, but the lost business, that can put you under. Exactly, Sarah exclaims. I'm missing my biggest catering deliveries. I'm losing customers. When we built your policy, Sarah, we talked about this exact risk. You might not remember, but you didn't just buy a standard policy. We added a crucial endorsement. Let me see here. Yes, here it is. It's called rental reimbursement with downtime coverage. Sarah, Your policy will pay for you to rent a replacement vehicle of a similar size and type while your truck is in the shop. Sarah slumps into her chair, the phone feeling heavy in her hand. You're kidding me. I can just rent another truck. Not just any car, David clarifies. It has to be a commercial vehicle comparable to your damaged one, which is exactly what you need. Your policy covers up to $150 per day, for a maximum of 30 days. We have a partnership with a national commercial truck rental company. I can make a call right now and have a truck waiting for you to pick up this afternoon. You can get back to your deliveries tomorrow morning. Tears well up in Sarah's eyes. Not tears of sadness or frustration, but of pure, unadulterated relief. The stress that had been a physical weight on her shoulders for 14 days begins to evaporate. The endless, sleepless nights worrying about her business, her employees, her customers. It was all based on a misunderstanding. She had the solution the entire time. She just didn't know how to use it. David, she says, her voice thick with emotion. I had no idea. That's why you have an agent, Sarah, he replies gently. A cheap policy from a 1-800 number gives you a piece of paper. A good policy from a dedicated agent gives you a plan and a partner. You thought your policy was just a defense against getting sued. But it's also a sword. It's a toolkit to keep your business running when the unexpected happens. The liability coverage protects you from Mark. But the collision, the rental reimbursement, the downtime coverage, that protects you from the situation. It protects your revenue. It protects your livelihood. In that moment, everything crystallizes for Sarah. All those years of paying her premiums, wondering if it was worth it. She finally understood. She wasn't just paying for insurance. She was investing in certainty. She was investing in a recovery plan. She was paying for David's expertise, for his calm voice on the other end of the line, for the power of a massive insurance company to go to war on her behalf. The conversation with Mark's adjuster was a battle of attrition she was destined to lose. But this conversation, this was a strategy session with her most powerful business partner. She hung up the phone with a clear set of instructions. Get an estimate from an approved body shop, send the police report to David, and go pick up her rental truck. The fight wasn't over, but it was no longer her fight to wage. Her champion had just stepped into the ring. While Maria was focusing on keeping her delivery schedule intact with the rental, David was waging a two-front war. The first front was internal. He coordinated directly with Maria's insurance carrier, initiating the collision claim. He sent them the police report, the photos Maria had taken, and the preliminary estimate from the body shop. Because Maria had the right coverage, her own insurance company didn't hesitate. They approved the repairs and paid the shop directly, minus her $1,000 deductible. They knew the other driver was at fault, and they were confident they'd get their money back. The second front was the real battle. The other driver's insurance company. As predicted, they were difficult. They tried to claim their driver had a green light. They questioned the extent of the damage to Maria's truck. They delayed, they deflected, they did everything they could to avoid paying. But they weren't dealing with a stressed-out, inexperienced business owner. They were dealing with David. David had seen these tactics 1,000 times. He calmly and systematically dismantled their arguments. He pointed to the officer's citation on the police report. He submitted a statement from the witness who saw the whole thing. He had the body shop provide a detailed breakdown, showing how the angle of impact was consistent with Maria's story. Every time they threw up a roadblock, he had an answer. He was a professional fighting on his home turf. Maria never heard about any of this. She didn't get a single frustrating phone call from the other insurance company. She didn't have to argue about repair costs or prove her innocence. Her only calls were from David giving her simple updates. The truck is in the shop, parts have been ordered, and 3 weeks later, good news. You can go pick her up tomorrow. She's good as new. And the best part? A month after that, a check arrived in the mail. It was from her insurance company for $1,000. David had successfully won the subrogation battle. He forced the other carrier to accept full liability. They reimbursed Maria's insurance company for the entire cost of the repair, the rental truck, and finally, they reimbursed Maria for her deductible. In the end, the accident cost her nothing but a few hours of her time on that first chaotic day. Her business never missed a beat. Her dream didn't crumble. She was made whole. Now let's pull back the curtain. Maria's story isn't about luck. It's about a series of smart, deliberate choices she made long before that red light runner ever entered her life. Her happy ending was written in the fine print of her insurance policy. And this is the core of what you need to understand. This is the ultimate checklist for what to look for in a commercial auto insurance policy. First, let's talk about liability limits. Maria wasn't at fault, but what if she had been? What if she had been the one who ran the light and hit a surgeon, putting them out of work for a year? A state minimum policy of $25,000 or $50,000 would have been exhausted in a nanosecond. The rest of that massive lawsuit would have come directly after her business assets and her personal assets. Maria carried a $1 million liability limit. It was the fortress protecting her entire financial life from a worst-case scenario. Don't ever skimp on liability. It's the foundation of your entire policy. Second, and the absolute hero of Maria's story, physical damage coverage. This is comprised of collision and comprehensive. Collision is what paid to fix her truck after the accident. Comprehensive would have covered it if it were stolen, vandalized, or hit by a falling tree. Without collision coverage, Maria would have been completely at the mercy of the other driver's insurance company. She would have been the one fighting them for weeks, maybe months, all while her truck sat broken and her business bled money. Her own policy stepped in and paid the bill immediately. That is its power. When you're looking at a quote, don't just see a line item for collision. See your ability to get back on the road in days instead of months. Third, the lifeline for her business, rental reimbursement. This is what paid for the rental truck that kept her income flowing. So many business owners skip this to save a few dollars a month, and it is a catastrophic mistake. Ask yourself a simple question. If your primary vehicle is out of commission for 3 weeks, does your business stop earning money? If the answer is yes, then rental reimbursement isn't an option, it's a necessity. Some policies even offer a more robust version called downtime coverage, which can pay you a set amount per day for your lost income, giving you even more flexibility. Make sure you have one or the other. Fourth, the invisible safety net, uninsured and underinsured motorist coverage. What if the person who hit Maria had no insurance at all? Or the bare minimum state-required limits that wouldn't even cover a fraction of her new truck's repair bill? That's where this coverage kicks in. It acts like the other driver's insurance when they don't have any or don't have enough. It protects you from the irresponsibility of others. In a country where 1 in 8 drivers is uninsured, driving without this coverage is like walking a tightrope with no net. Fifth, the human element, the champion in the ring. A dedicated, independent agent or broker. David wasn't an employee of the insurance company. He worked for Maria. His job was to advocate for her, to navigate the system for her, and to fight for her. You can buy a policy online from a faceless company and maybe save $100. But when a claim happens, who are you going to call? A call center? An automated system? Or a professional like David, whose name you know and whose job it is to have your back? The value of a great agent is zero until you have a claim, and then it becomes priceless. Find someone who specializes in commercial insurance, someone who understands your business, not just someone who sells car insurance on the side. Finally, the company behind the curtain, the insurance carrier itself. Not all insurance companies are created equal. You want a carrier with a strong financial rating. An A rating from a service like AM Best is a good benchmark. This means they have the financial stability to pay out large claims without issue. You also want a company with a reputation for fair and fast claims handling. David knew Maria's carrier was solid, which is why he was confident they'd approve her claim quickly. An agent can help you sort the good from the bad, but you can also look up company reviews and ratings yourself. The cheapest policy in the world is worthless if the company behind it refuses to pay when you need them most. So, how do you put this all together? When you're shopping for commercial auto insurance, stop looking for the cheapest. Start looking for the best value. Create a checklist. $1 million in liability, collision and comprehensive with a deductible you can comfortably afford. Rental reimbursement or downtime coverage. High limits for uninsured/underinsured motorists. Then find a specialist agent and interview them. Ask them, if I'm in an accident like Maria's, what does your process look like? Who is my point of contact? How do you handle difficult claims? Their answers will tell you everything you need to know. Review your policy every single year. Has your business grown? Have you added more expensive equipment to your vehicle? Has your revenue increased? Your policy is not a set-it-and-forget-it document. It's a living shield that needs to grow and adapt along with your business. In the end, commercial auto insurance isn't an expense. It's a strategic investment in resilience. It's the silent, ever-vigilant partner that guarantees one bad day on the road doesn't get to destroy a lifetime of hard work. Maria built her floral business from a dream, a single truck, and an unbreakable will. But what kept that dream alive wasn't just her own strength. It was the strength of the promise embedded in her policy. A promise that when disaster struck, she wouldn't be fighting alone. Choose your policy wisely, and you'll be buying more than just coverage. You'll be buying peace of mind. You'll be buying certainty. You'll be buying the freedom to keep driving toward your dream, no matter what bumps lie in the road ahead.